Hi, this is R.N. Bhaskar from BKBB, which is an acronym for Bhaskar Ki Business Baatein. This is a channel that brings to you every week a policy analysis, an occasional business story, and an occasional conversation. But at this time, at 8:15 in the morning on weekdays, Monday to Friday, we come to you with news behind the news. And this is a channel that picks up a few headlines which you think are important and tries to analyze the developments that must have taken before or after it. And yes, just before I continue, just a reminder, please click the subscribe button. If you're not a subscriber, please click the like button if you like the program. It helps us. And most important, please tell your friends about us. It helps our audience grow. And today we have with me my co-anchors Katya.
So,
Katya, welcome. And Anurag. Anurag is also here. Yes. Thank you both of you. And today's headlines that we're going to talk about are given on the screen. The first is that 30-year bonds of the US are going to open today, and the markets are skittish. The second is how mutual funds have suddenly seen a decline in inflows. And the third is RBI's plans to galvanize growth in India. All the three titles are relevant, and let's start the first. The US wants to raise about $34 billion from the debt market, from the bond market, through the bond market, of which 22 billion are 30-year bonds. Now, market men believe that these 30-year bonds may not succeed because that is too long and the dollar's future is getting a little hazier. And many people believe that that this 22 billion may not be raised unless, of course, the US gets other people, twists the arm, and tells them to buy the bonds. Already, if you look at the yield chart, bonds have already started demanding a higher yield than in the past. When bond yields climb, it suggests that people are nervous, people are not sure, and as usual, the longer the period, the greater the nervousness. In the past, 30-year bonds had a much, much lower interest rate. Today, the US is not the same. Of course, there's a good development. Yesterday, USA and China seemed to arrive at an agreement, and both agreed that they had understood each other. But there is a problem. And that is, the USA said, we will get rare earth magnets immediately. China said, we'll try to normalize trade step by step. Effectively, while that agreement has been reached and all of them posed for a photograph together, there are many gaps here and there, and we will see what happens. The US wants rare earth magnets urgently. China wants all the tariff and non-tariff barriers to be removed immediately. That includes semiconductor chips, both from the USA and from the others. And the US said, we will not allow NVIDIA already. So there's some, I don't know what the truth is, but China has not come up with a detailed statement. They'll do it after they reach China and discuss everything internally. Watch that space. If the trade deal succeeds, the markets may have some stability. If it does not, expect no volatility. And the second story is equally important. And the second story is by Katya. She's going to talk about mutual funds. Welcome, Katya.
sir, yes, thank you, sir. And this whole volatility that was pushed up by Trump and other issues have not helped the domestic markets as well. So this year's this month, May month's AMFI data shows a huge variance on the trend that we've been seeing for the last 2.5 years. So the equity mutual fund inflows fell 22%, and they hit a 1-year low. And so which means they're back to where they were 1 year. And then large cap funds witnessed a steep 53% fall in net inflows. So net inflows is important, which means there could have been redemptions as well. While there are investors, a lot of people might be pulling out also to book profits, which doesn't seem like a bad idea in a market like this. Mid cap funds registered a 15% dip. Small cap are also in the same range, 19%. But we saw a lot of redemption from debt based schemes as well. So now, why is this important in this particular context is that a lot of domestic market strengths, the growth of DIIs in the market, and there we've seen a lot of bulk deals, block deals. A lot of purchasers were mutual funds. They were investing in IPOs. All this is because of the backing they were receiving from mutual fund investments, which went up exponentially. In fact, that's why we were able to survive the onslaught of FIIs pulling out and being extremely volatile as well. So all this strength came from mutual funds. A lot of market strength came from mutual funds. While even now, a lot of them are sitting on interesting amounts of dry powder, so they can sustain it at this levels. Growth might be little stifled if there isn't, regular flows into mutual funds. So what do you think, sir? Do you think it's going to, the volatility is a given? People might be smarter to pull out money from mutual funds, but what does it mean for market participants?
That is what is interesting. Now that money has started going out of mutual funds, it could mean two things. That in spite of RBI's attempt to increase liquidity,
Hmm.
liquidity is tight, and many of the people who are big players in debt funds and wherever, they want their money because they want to sit on money.
Right.
The second problem could be the economy does not have enough purchasing power, and people have
Right.
decided that it's enough to put in mutual funds and we're going to get it. I don't know. Let's see. But it's very interesting, a very interesting development that you come up with. Thanks, Katya. And we've got a third story also, which is markets related in a way, and that is by Anurag. Anurag, could you come in?
Good morning. The RBI has shaken up markets with the biggest rate cut in 5 years to cut its key repo rate by a steep 50 basis points and even slashed banks' cash reserve ratio by 100 basis points. The RBI has set out an aspirational growth rate of 7 to 8% for the economy, ramping up from an already world-leading 6.5% expected this year. This growth trajectory comes along with an assurance of abundant liquidity and in the banking system, as Sir has just mentioned. The central bank's aspiration is in lines with its agenda, as some economists estimate that India needs economic growth of close to 8% a year to create enough jobs for its 1.4 billion people. These measures by RBI particularly aim to boost investments by micro, small, and medium enterprises, also known as MSMEs, as nearly 80% of retail and particularly SME loans are now linked to external benchmarks such as the repo rate, meaning borrowers will see interest costs drop almost immediately. The MSME sector contributes 29% of India's GDP and employs over 60% of the country's workforce. In contrast, just 16% of overall bank credits goes towards this sector as of April this year. Banks, however, perceived SMEs as high risk, charging them interest rates much above those offered to large companies. Moreover, in 2023, a sharp uptick in unsecured loans prompted tighter norms by the RBI alongside concerns raised about elevated credit deposit ratios in certain private banks. But now, as experts say, that banks are far better geared to lend to these segments and shall focus to quickly ramp up loan growth. The success of RBI's pivot now rests with banks' willingness to lend and borrowers' readiness to take on the leverage. What's your take on this, sir?
Well, the RBI has made these statements, has reduced the interest rates. Great. But does RBI make economic policy? I don't think so. It can only increase or decrease rates, control the flow of money. A lot of things are outside the RBI, which is the finance ministry and politics. Freebies being given. And the RBI has contributed to the freebies by giving the largest ever loan, a dividend, sorry, to the government. That was not a very wise move. from the money management point of view. There's another problem. Unless FDI comes in and domestic businesses also invest in new businesses, you won't create jobs. Without jobs, you won't have consumption increase. You need jobs for which you need investments. Domestic investors have become shy and they're investing overseas, and overseas investors are not coming in because they're not ready. Please remember, even the FTA with UK did not have the BIT, which is the Bilateral Investment Treaty, because I don't think UK wants to invest in India. And while the ministry says that yes, we'll have an FTA with EU, privately he has told us that no, till the BIT is in place, we are not investing. So let's see what happens. It's a very perplexing situation. The RBI is only part of the puzzle. And that, in a way, finishes the story. But let me go on to the questions. And before the questions, can I do the second reminder? Do click the subscribe button if you're not a subscriber. Click the like button. It helps us. And most important, you know anyone, any friend, please tell them about us. We would like to grow even further. And now let's take up the question. Will the growth be real by RBI, or will change the 2023 GDP? Please remember, in spite of all kinds of pressures, India's GDP did not grow beyond 6.5%. The World Bank had to scale it down. Increasing GDP growth is not an easy job. There are many issues involved, and that brings in politics and policies that do not seem to be in the right direction yet. Let's see what happens. And then there's another question for Katya. The question is something that Katya will... Okay, let Katya handle it. So is investing in MFs a very safe bet?
So again, we are not supposed to give investment advice, but I just want to remind everybody, a lot of promoters are selling out through block deals. As we speak, there is another block deal alert which has come in. So please watch out in a market where promoters are selling and then safeguarding their wealth. What you should do is what you should think about a lot. But
Yeah.
it will not give the crazy returns that they've seen. People have seen very interesting returns in the last few things. Even now, SIPs are still holding on. SIPs can handle market push. Direct
Yes.
inflows, not so much.
Thanks. I knew you would say that we can't invest, and thank you very much for saying that. There's a third question. What if the China-USA deal doesn't work? Well, if it doesn't work, there's more turbulence. US had not anticipated the stranglehold China has on the rare earths and magnets market. US had thought by banning chips, by banning this, and even revoking visas of Chinese students, they could bring China to its heels. Finally, Trump had to make a call to China. And the meetings took place. They worked on some deal, but there's no guarantee that USA ever respects a deal. It's struck up many deals in the past. Let's see what happens. Anyway, that brings me to the end of today's show. Thank you for being with us. It's good to have you with us. And yes, have a great day. Enjoy yourself. And see you tomorrow morning. We look forward to it. Take care.